Hello, everybody. How are you? Greetings from Bangor, and also Eric, who I think you can see in the screen, is our guest today, the financial intelligence specialist from Canada. Just Nick, can you tell us, as well as the slides, can you see both Eric and myself?
Yes, yeah, everything's fine.
Okay, good. Okay, somebody's just expressed greetings from Jamaica, where it might be slightly warmer than it is in Bangor at the moment. When I was out this morning, the temperature was 12 degrees centigrade, much warmer than we've had, And Eric will now tell us what it is with him.
Yeah, not quite as high as you, Stephen, but we're on the plus side of 0 today, up to 8 degrees.
Wow.
Unbelievable.
Wow. Well, you can always presume that somewhere in the world there's somebody with worse weather than we have. So there we are. That's great. Thanks for making yourself available, Eric. It's an exciting topic. It's an exciting time to be looking at financial intelligence. And of course, financial intelligence means different things to different people. We'll be exploring a couple of recent cases where intelligence about financial matters would have paid dividends. So we have a couple of slides, well, a few slides for us to look at. It's not a big lecture. We're not going to labour on the slides. Then I'll ask in this conversation piece, I'll ask Eric for his opinion on a few things, and then we'll open it up to you all. So I'll move forward yeah, there we go. It's a conversation with Eric. He's from our partner, ManchesterCF, and ManchesterCF is our partner on the MBA in Financial Crime and Compliance. And the session today is about financial intelligence in the global banking industry. And I thought what we might try and do is we'll have a look at some slides about two situations, but the bulk of the time will be questioning what kind of intelligence is required. Certainly in the MBA Financial Crime and Compliance, we may presume it's about intelligence to try and catch criminals in the finance industry of various kinds. And that's true. But there are other reasons for looking at financial intelligence or intelligence in financial services, and we'll have a look at those. So the kind of things that we're expecting to talk about are don't tell us it's 28 degrees C in Kingston, thank you. Was it Tricia? You know, what am I going to do? I'm going to close down and go and jump on a plane. Yeah, Tricia, send us some of that warmth, please. What kind of intelligence is required in financial services? What's the purpose? What are we trying to achieve by having intelligence? And how do we expect to achieve the objectives? We started with this idea of this webinar, which includes people who are already on the program. Could be Financial Crime and Compliance MBA, could be the Chartered Banker MBA, and people who've expressed an interest. It also could include some of our own alumni who have graduated. A wide audience. Since we set the date and the time, of course, it's an interesting example of continuous change. There's always change. Silicon Valley Bank went into difficulties and had to be rescued, and that gives us some additional lessons about financial intelligence. Not that I'm in any sense trying to imply that there was any criminal intent, but nevertheless, a different kind of intelligence might have helped Silicon Valley. The next slide, take a quick look at the picture of Eric, and then there's another picture of Eric. I can't be sure if it's the same glasses or not. We're not going to zoom in and have a look. There is our guest today, Eric Hansen.
Same person, I swear.
Sorry?
It's the same person, I can assure you.
And you can read a little bit there about Eric's background, advising clients on issues pertaining to regulatory compliance and operational risk for 15 years. A lot's been going on. And as we'll see in our our little chat today. A lot's been going on in less than 5 months in financial services, and as I say, not always with fraudulent intent. So he's a director at ManchesterCF Financial Intelligence, our partner on the MBA Financial Crime and Compliance. On March the 17th, we're only on the 23rd today, so it's a week ago. Global banks shed some phenomenal amount of market value, $459 billion, because markets just took fright. They took fright. And is there a way to increase the size so we can look at the smaller print? Nick, do I have that power, or is that something you do?
I think Shauna, are they Shauna's slides? I think she might be able to.
Are you able to just increase the size of the slide?
I don't think I can increase the size, I'm afraid.
Okay, well, I'll read you through some of the points, and the slides will be available afterwards, will they, Sinead?
Yeah, I can make them available to everybody that's attended.
Okay, so the text in the box underneath the headline says investors have wiped nearly $500 billion from the value of bank shares around the world, following the biggest rout of the financial services sector since the onset of COVID. Nothing to do with COVID this time. They dived following the collapse of Silicon Valley Bank. Banks in the US, Europe, and Japan, they've all collectively lost huge amounts. In the KBW Bank Index, 18% loss. Europe's stock 600, 15%. So it goes to show how globally connected we are. And you might think, wow, that's the biggest problem that we're facing. But here's one which happened, well, yeah, 4 months ago, is it now? Cryptocurrency, the confidence or lack of it when the crypto world was rocked by the fall of the FTX empire based in Bahamas, having moved from Florida, I think. $32 billion US, the group, and it filed for bankruptcy. This is November. Interestingly, there is some suspicion of perhaps inappropriate behaviour, certainly with regard to the relationship between Alameda Research and FTX itself. And there's a quotation there. It's all rooted in a lack of transparency and conflicts of interest, was a quote in that Financial Times statement in November. Former employees described lack of basic controls and bookkeeping, the absence of trustworthy financial information, financial intelligence. Was it just haphazard, or was it intentionally chaotic, including toxicity from management, structure, and the company culture? The reason I mention this is because a little later on we're going to say, could we leave the collection of financial intelligence and acting on it just to technology itself? Could we use AI to do this? Interestingly, in the same week that FTX went down, the watchdogs in the US, the regulators, were playing a blame game. Who should actually have watched this? Who should have had the intelligence about what was happening at FTX? Is it regulators? Is it lawmakers? Within a 4 or 5 month period, 2 clear needs for intelligence in financial services. However, surprisingly, last week in the same series of articles in the Financial Times, although there was this huge loss in what we may call traditional banks and their stock valuations after Silicon Valley Bank went down, focusing heavily on lending to the tech sector, Bitcoin bounces. And there's a statement there that says it has historically been the case that when conventional banks are under pressure, some people switch to thinking about crypto. But how do we get sufficient information about all of this? Here is the The week that rocked banking. The Sunday Times this time. It's all over the weekend. I can't remember a day like it since 2008. Oh, that's a sharp thing to say, given that that was the global financial crisis. And writing in the Sunday Times, Martha Lane Fox, famous as an entrepreneur, not necessarily as a banker, but successful in her own right, said perhaps the problem was being too sector specific, funding only certain kinds of activities and not protecting against interest rate rises, contagion of anxiety. So there's behaviour in here, which is perhaps more than just allowing technology to do it. However, she's quite positive in the end. She says the power of business networks rescued a bank. Here in the UK, Silicon Valley Bank UK was acquired for £1, I think it was, by HSBC, who saw value in it. And in fact, the quotation at the bottom from HSBC, Noel Quinn, says, I had to save Silicon Valley Bank UK. It's a business of the future. Well, it's funding startups and companies which are the future. Erwin Stelzer says the iceberg was in plain sight at SVB. So, why didn't somebody act? Was it regulators, or is it just purely an internal matter? How do you stop a banking crisis when fear has become contagious? In general, AI doesn't succumb to fear. It's humans that succumb to fear and panic, etc. So there's setting the background. Interestingly, if we pick up on that quote from, I can't remember a day like it since 2008. Here's what the Bank of England said 10 years after the banking crisis, so-called global banking crisis in 2007-8. 10 years on, the Bank of England reminds us the sequence was in September 2008, Lehman Brothers fails, but in October 2008, system-wide, all the regulators came together, international coordination, and looking forward here, I've got 4 little red arrows that I've put there, which I wonder if the slide would get bigger if we closed the pictures of Eric and I and people. What would this do here? Let's just have a look. No, Stephen, don't do things like that. Don't press buttons. Is it possible to hide, Nick, or Shoned, is it possible to hide Eric and I from your screens so that instead of having pictures of faces, we have the slide a bit bigger? Is there anybody there? Said the traveller. Okay, somebody says we can see the text. So the Bank of England says, well, 10 years on from Lehman's Brothers, the global financial system is safer and more resilient. Oh, dearie me, that was in 2018. The Bank of England said that. And what are we, 4 years later? Ooh. However, they do say the top, the arrow here, this arrow, the uppermost right arrow says, one thing is certain, the next crisis, there will be other crises. Yes, indeed, there have been. And the next crisis will not look like the current one, the last one that we had in 2008. So they acknowledge there are always going to be crises. We need to have information. Technology will play a role, it says here on the left-hand side, the uppermost arrow. Technology will continue to have a transformative impact. So we actively monitor the impact of crypto assets. Yeah, very good. But it's obviously clear that okay, if you go to view at the top and focus on content. Okay, a bit bigger there. So temporarily we hide Eric, permanently we hide me. So you can see technology will continue to have a transformative impact. Fintech can pose a number of challenges for banks. Yeah, you'd better believe it. But there are clear prospects for new technologies to make the system more efficient, more effective, more resilient. Yeah, that certainly offers that potential. And what the Bank of England says, we aim to ensure the UK financial system is resilient to and prepared for the wide range of risks it could face. They finish optimistically. That way, the system can serve UK households and businesses in bad times as well as good, i.e. society at large. Well, enough of the history. That leads us on to say, what kind of intelligence is required? Just kind of intelligence is required. Well, there's a slide somewhere. Let me just check. There we are. So we had a comment earlier on that the US watchdogs were playing blame over who should have been watching FTX, the cryptocurrency. And if you want to get a sense of how complicated it is and who's affected by it, society at large, the regulators have a role, employees are affected by it, shareholders, stockholders, managers, customers. Oh, dear me, there's a large number of people who have an interest because they're affected by it. And the Bank of England says, well, what we hope we're doing in the Bank of England is we're ensuring the UK financial system is resilient and we can serve UK households and businesses. We come to the question now, what kind of intelligence is required? Could we possibly benefit by rephrasing Martha Lane Fox's comments about Silicon Valley? Did it show intelligence, financial intelligence, to focus on a single industry sector? Did it show intelligence not to sufficiently protect against rising interest rates? Was there a way to protect? And about the FTX collapse, when they the commentators in the slides above say it was all rooted in transparency, or rather the lack of it, the conflicts of interest, the lack of basic controls. I mean, who should have been watching this? The absence of trustworthy financial information. Who monitors these highly, well, they seem very attractive, but also risky activities? Note the bottom comment, which was previously on an earlier slide. Toxicity in the company, from management to the structure to the company and culture. Enough of me. There is another slide that we'll have a look at in a moment, but now's the time to ask Eric for, let me see if I can go back and we get a picture of, there we are. Eric, what kind of intelligence is required? I know they're two very different situations. Silicon Valley Bank, we're not claiming there was anything at all with criminal intent there, but they were very focused on one particular sector. Yep. Could they have done anything when interest rates started rising quite quickly? Were they locked in? Were they overly confident? Any thoughts?
Sure they could, Stephen. And it's a wonderful question. And thank you again for inviting me to this call today. Always a pleasure regrouping with colleagues and our partners at Bangor. But I love these two cases. I think there's, lots to unpack here. It's a fantastic question. What kind of intelligence is required? There's a great article in the Wall Street Journal today outlining how Silicon Valley Bank did not have a chief risk officer for nearly 1 year. So, wow. Yes, in the case of Silicon Valley, it looks to, certainly from an outside perspective, looks like a series of bad bets, right? Nothing fraudulent that I've necessarily seen so far, but a series of bad bets, including mortgage-backed securities. If you want to rewind to the last financial crisis, it was interesting to see, this crisis, the next one, I think he said, won't be the last one, but very interesting undertones with mortgage-backed securities that Silicon Valley had gambled on, and without having that chief risk officer in place. As an aside, it looks like, speaking of chief risk officers, Signature Bank that also went down, their chief risk officer had previously been their outside auditor from KPMG, makes you wonder, and other banks who had maybe a chief risk officer in place just as a sort of figurehead, right? So what kind of intelligence is required? Certainly, I think at SVB and Signature, somebody really taking a hard look at risk, assessing those risks on riskier bets like mortgage-backed securities. And could you say, sure, were the regulatory bodies there in place to overlook these things? I think there's always certainly that outside governance to consider. But to me, it was certainly glaring to see, okay, these guys, how much did they really care about assessing risk if they didn't have someone at the table in that role?
Yeah, very true. I mean, I think the kind of things you're saying there echo some of the material that you see published going back to the late 1990s, where boards of banks, not necessarily only in the US, but would appoint somebody with the title chief risk, but actually at the same time they say, we need performance, and the chief risk officer goes, this could be risky, and they go, well, can you quantify that? Oh, let's try it and see, because of course there's a twin pressure. Avoiding risk might mean less growth, whether it be in terms of dividends for shareholders, or be bonuses for directors and managers. So there is this tension. But as you say, fancy not having a risk officer for so long, and then you get somebody who was previously from one of the big accounting firms, KPMG, as the risk officer. Yeah, does that say something about the background they came into, or did they just enter a culture, as it says under the FTX collapse? It's about company culture as well. This tension between the board saying, yeah, we have to comply with these things. Pity the poor risk officer and the compliance function stuck in the middle between individual employees who've got wonderful ways to make money, the board saying, oh, we have to comply, and at the same time, but we want growth. Can you square the circle, Eric?
I was just going to say that an unenviable job to be that chief risk officer at a place like Silicon Valley Bank, where, to your point, the culture was on gambling big. If you look at some of the tech startups, these are firms that certainly did not generate profits, and many of them did not even have revenue. And you're investing. Certainly, there's from a venture capitalist perspective, investing millions and even billions with a B into these startups. So you have an entire culture on the West Coast of taking big bets. Certainly, some of those pan out very well, and you see people getting rich. But at the same time, I think there was, just a tremendous amount of. Now, I understand that's starting to shift a little bit, but when interest rates were very low, there was a culture of taking big risks, and so yes, certainly an unenviable a task to be a chief risk officer, chief compliance officer, those places. If you look at FTX as well, I think in that case there was hardly any compliance, as we now discover and learn more about that firm and its governance. There didn't seem to be any sort of compliance policies and procedures at all, and very little oversight by regulators, because crypto was supposed to be the opposite of banking. They didn't want this to be regulated. They didn't want that sort of additional layer of oversight. So two different cases. I think in the case of both, though, I mean, going back to what type of intelligence, what could you do if you were in the compliance or a risk function at either one? And I think, it's trying to get buy-in. It's alerting management of the risks that are perceived, and trying to change that culture by getting buy-in from the board and from leadership. Easier said than done, to be sure. But I think, knowing what the risks are, being able to assess them, and then communicating those effectively with peers within the organization would have gone a very long way.
Yes, I mean, you asked the question, what do you do if you're in a risk function and nobody listens? Well, one alternative is to get out if you think there's any vacancies anywhere else that are different. And yeah, and somebody was telling me only relatively recently, nobody wants to hear about compliance until they see their own company's name in the headlines and then say, what were you guys in compliance and risk management doing? We did try and tell you. So I think that moves us on quite nicely to intelligence for what purpose and how can we achieve it? Intelligence for what purpose? I'll step back a couple of slides. In the what the Bank of England said. The Bank of England said, I'll read it out from the copy I have here, which is slightly larger. We aim to ensure the UK financial system is resilient to and prepared for the wide range of risks it could face. That way, the system can serve UK households, i.e. Joe Public and Mrs. Public, and businesses in bad times as well as good. And then we see the huge range of stakeholders who are involved. So we go back to the question, what is it, the purpose of it? Who are we trying to protect? Customers, investors or shareholders, employees, public society at large? And perhaps we can talk a little bit about that and at the same time as the box on the right-hand side that is protect from what? Poor management decisions versus fraudulent activity. And in case we get sued, both Eric and I have said we're not aware of any accusations of fraudulent activity in SVB. It's just there was a gung-ho spirit that carried on even when interest rates began to climb, having had a culture of taking big risks when interest rates were low. Who are we trying to protect with this financial intelligence, Eric? And what are we trying to protect from?
Yeah, I mean, this is it goes to a sort of existential sort of question of what is the purpose of business? What purpose do banks serve in our society? I think 20th century views were that the corporations exist for the shareholder and shareholder value, aka profits, right? Dividends and the price of the stock. I think there has been a shift in attitude, I really do, towards preserving stakeholders. So more than just somebody who owns a share in that organization, right? For a bank, customers, suppliers, the community at large. Joe and Jill Public, as you say, Stephen. So I think, yes, it's important to, and I really do see that out there. I appreciate the Bank of England's tone there, but certainly Bank of Canada probably would echo that, is that there's definitely value to society at large. If an important bank, and there's 5 or 6 of them here in Canada, were to somehow go under, that would have massive implications. Tens of thousands of people work at these organizations. We have our life savings in them. So I think, to protect whom, all of the above that you have on your list there, public society at large. From what? Yes, as well. Management decisions, big risks, that sort of appetite to always, just do anything for the sake of profit, to protect from, anti-money laundering and anti-terrorist finance sort of activities, as well as fraud that could hurt everyone from employees to customers to various stakeholders.
Yeah, and of course the phrase which has become famous has been not only in the UK but around the world: too big to fail. Too big to fail. You know, these banks are so large we cannot allow them to fail. And sorry, let me just switch that off. Okay. Technology, don't you just love it? Throw it in a bucket of water, Stephen. Right, that's solved that problem. Back to the game. So too big to fail. And if you, when you get these slides, want to have a look at what the Bank of England talks about in that report, perhaps a little optimistically, but with the heart in the right place in 2018, 10 years after the global financial crisis, they talk about people, there were runs on the banks. Things that hadn't been seen for decades. People were queuing outside banks to try and get the money out. Northern Rock, and the government here, and indeed elsewhere in the world, had to step in to protect, because they were so important. The 4 or 5 biggest banks in the UK. You know, if one of them falls, exactly the same as Eric said in Canada, too big to fail. There's an interesting link into the next part of the slide, Eric. You were talking about the traditional view, certainly in Western business society, shall we say, over the last few decades, that companies existed to make profit, which went to the people who either managed them, the directors, the managers, or to those who gave the funds to generate that, so the shareholders. And of course, Jack Welch was a very famous example in General Electric, and he had this this mantra that it was all about the shareholder and dividends. And of course, it paid him well, because his bonuses and eventually his pension package, I'm not being cynical, his pension package was based on the share price growth and things. When he retired, he said, you know, I might have got this slightly wrong. Because of course his bonuses didn't depend on it anymore. Perhaps his share values did. But he said it's not just shareholders, it's a wider set of stakeholders of the kind we've just been talking about, and Eric was talking about. You know, it is other people, even though they may not even be customers of the bank. They certainly may not have invested money into it. And so it leads to the questions, I think, which are in the second half of this slide, which on my screen is pink. And it says, what's the purpose of intelligence? Yeah, we've established that. How are we going to achieve it? Should it be something that only these are internal questions for managers of companies and perhaps for the investors? Well, to some extent, we might almost have answered that one already when Eric said, you know, it isn't just the investors, the shareholders, it's society at large. Or should it be monitored externally by regulators, lawmakers? We saw a couple of slides ago that they fell out with each other to some extent in November 22. Whose fault was it? Was it our fault? Was it your fault? Etc. And of course, regulators would say we can only do what the law allows us to do. So surely it must be you, the lawmakers, that do it. Or what about if it's internal, to avoid poor management decisions? If it's external, what about self-interested and knowledgeable industry groups? Martha Lane Fox in her article said it was actually networks of people who are in the industry who helped officials to gather the data, to gather financial intelligence about the SVB situation in Silicon Valley Bank UK, to look at its effects and things. These are the kind of things you would think companies were doing. They ought to be doing as professional managers. What is it, Eric? Should it be something that's purely internal? Can we allow people to police themselves? Should it be completely external? Is there, as we see in some industries, not only financial services, the industry comes together and says, you don't need to regulate us very hard because we will regulate ourselves. We'll be self-regulating, self-interested and knowledgeable. 3 different choices there at the points of a triangle. Internal only, external only. I don't know. What do you think?
Well, look, in the case of, I mean, this $1 million question, right? £1 million question. But I do think okay, let's look at banks that are too big to fail. what does that really mean? Does that mean they get blank checks to take as many risks as they want? Just roll the dice on a roulette table? That analogy probably didn't work, but you know what I'm saying. I think if it is an institution that is deemed too big to fail, then we have every right to monitor them externally by regulators, by lawmakers, because their very existence means so much to our society that that they cannot afford to make, you know, these big mistakes. So I think it does merit sort of external regulation. You see, you know, where there's a lack of that in certainly the crypto industry in the past couple of years, where they really truly resisted all of these things. And when the price of crypto assets was skyrocketing, everyone was happy. But there was also a run, right, on crypto at these crypto banks where people were trying to get their deposits back, and they couldn't. And unlike the banking sector, none of those funds were insured.
No.
Right. So people across the globe lost a lot of money when that occurred. And we saw, you know, in this case, when there's no oversight from regulators and lawmakers, nothing is insured. There was a lot of panic. So yeah, I think there's definitely, you know, having worked in anti-money laundering for quite a few years now, the whole purpose, you know, we don't do AML for fun. The whole reason is to try to crack down on illicit behavior, right, for society, and the predicate offenses that stem from, or that money laundering stems from, such as human trafficking, wildlife trafficking, terrorist financing, and the rest. I mean, these are really bad things. So, you know, the purpose of these things is to we have external oversight in industries like this where there is, you know, potentially grave threats to society at large if we get it wrong.
Absolutely. And I think that leads us nicely, or allows me just to jump back a little bit to what the Bank of England talked about. They talk about the use of technology. So before we open it up to any questions that you might have for Eric, so be thinking of your questions. Probably the simplest way is for you to post them in chat. I'll pick them up and read them out. But let me just return to the Bank of England's conclusion in 2018, 10 years after the global financial crisis. Technology will continue to have a transformative impact on financial services. And we, the Bank of England, more actively monitor the impact of crypto assets, fintech, etc. Fintech can pose a number of challenges for banks, but there are clear prospects for new financial technologies to make the financial system more efficient, effective, and resilient. So the question before we open it up for delegates, Eric, is, yeah, I think if we accept too big to fail, then these institutions have some obligations to be monitored and regulated. The question comes, the compliance function within an organization, which is a bit back to this question of can we do it internally? The compliance functions and the chief risk officer, as you were just saying a few minutes ago, you know, is an unenviable task. Compliance functions are often relatively small in size. Should we think about picking up on what the Bank of England said and let technology do it all? You know, there are literally hundreds of millions of transactions, billions of financial transactions. Let the technology do it, the AI. Take it out of the hands of humans. Does that form of technology offer a solution to any of this?
Well, this is sort of where I've spent my career, is building technologies within compliance. So point, you've got millions of transactions occurring at a financial institution. it's impossible for a compliance team to monitor all of them. So you build a sort of a software, right? You use artificial intelligence to look for suspicious transactions. But from there, at least in my experience, the technology can alert suspicion, but it needs, it needs human intelligence to then review that and say, look at a case, look at the file, and really truly examine to see, was this suspicious? How risky was it? Or, maybe this is a kind of false positive picked up by the system. And for those of us working in compliance, we know false positives happen all the time. To say the technology is extremely useful, but it's flawed. We need human intervention, not to mention for writing that suspicious report that essentially goes to the financial investigations unit, goes to the regulators. That report, we've seen technologies that try to write these reports for us. They're no good. It needs a narrative, because the person at the other end, that government official, the person working in the national FIU, there's a human being on the other end of that. So what we see are the most effective reports are those written by people in a narrative kind of way that says, look, we suspected this risk, and it ties to this other case and geographies, etc. Right? So technology has been has certainly assisted in the battle against financial crime and money laundering, for instance. But to say that it can do it all, I haven't seen it yet. I think there's still a remarkable need for good, hardworking people who know how to leverage that financial intelligence.
That is an excellent answer, Eric, for all those people who are listening, who are in compliance, who are thinking, I'm going to be replaced by a machine, or those who are thinking, shall I get into compliance? Because to summarize what Eric said so eloquently, technology can alert. It needs humans to actually unpick it and think about intervention. And yeah, there are false positives. Just one final thing about behavior is, of course, sometimes human intervention says, rather than fall foul of the regulator, this one, I'll report it just in case. And then the regulator gets and the FIU gets stuck there. They're relatively under-resourced and they would quite like banks to self-police themselves. But just as in education, education can make use of technology as we are doing today. And this is not a heavy sell. This is a conversation with a specialist in financial intelligence. But education, you can learn it all from a book. No, you can't. You need to have interaction, which is where we've just come to, which is an opportunity for all you attendees to ask any questions. So far, we've had lots of reports of the temperature in various parts of the world. Thank you for that. And Bangor is still on 12 degrees C. Any questions? Boyd Anthony says, Silicon Valley Bank, lending to a company that does not generate income. I suppose that's on the basis of the idea that pretty soon we'll be generating income and then there'll be phenomenal profits. So yeah, the Silicon Valley was in the startup, very early startup stage. So I could see that being happening. But of course, if you have a portfolio that's all you've got, then yeah, there is risk associated with it. Of course, it had worked so well, as Eric said earlier, when you can take big risks when interest rates are low, and they'd been low for a long time. Many people, had never seen them increase. What other questions have you got? Any thoughts on that, Eric, while we get other questions? Come on, don't be shy. What questions have you got for Eric?
Yeah, I mean, just a thought on that as well. It seems, if we were investors and pooled our money together and we were looking at a bunch of companies to invest in, it would probably seem, certainly from my perspective, counterintuitive to invest in a firm that showed no revenue and certainly no profit and no projections of profit even in the past 5 years. But this has been the model in venture capitalism, certainly on the West Coast for quite a few years. You know, we have got a great idea for an app, and we've got wonderful people who can produce the app, and the app is going to change the world. But you know, I don't know, it's a free application, suppose, and so we've got users, we've got people on the app, and look, everybody loves it, but no revenue. So it's very much sort of pitching an idea. Now, you know, to Stephen's point, if that's all you had in your portfolio, maybe that chief risk officer said, we could diversify that. To make matters worse, I think for whatever reason, they also made bets on mortgage-backed securities. And so maybe they weren't around for the 08 financial crisis or seen the movie The Big Short. But
yeah,
those are also a very risky type asset. Now, full disclosure, I don't know certainly necessarily the regulations in place in America that says, listen, you need a certain percentage of your assets in this and a certain percentage of your assets, you know, and how much liquidity the bank needed. But clearly they got that formula. Silicon Valley Bank got that formula wrong.
yes. I mean, I think there's a role for corporate memory, as it's called, and when you've had a long period from 2008, when the last significant major crash was, that there will be lots of people in the industry, including many of those people in FTX who are only in their mid to late 20s. They'd never experienced this. They may have watched a movie about it or something, you know, no corporate memory that reminds them of this. I'm also reminded, just in passing, of when you talk about venture capitalists, some years ago, talking to somebody who said, what we do is for every 10 investments we make, we want a couple of stars. Okay, it's a normal distribution. We want a couple of stars who are really going to make our money for us. Then there'll perhaps be, I don't know, 6 or so who are in the middle, are okay. Yeah, we're making money on them. And there'll be 2 walking dead that we wish we'd never got into, and we've got to get rid of those boys. But who we're going to get them to? No one else is going to want them. So it leads into a question from Alan Scholl. It says, if the weak points seem to be chief or heads of risk, are the central banks shoring up the regulations of these functions? Just in passing, I'll expand on Alan's point, if I may. The weak point, in fairness to the chiefs or the head of risk, they may be trying very hard. It may well be the board who are actually sending mixed signals. So there was Alan's question. Should central banks be doing more? Are they shoring up these functions? Then Boyd Anthony talks about, is there a need to revisit the 3 lines of defence model, a more specialist type of financial crimes unit for risk management dedicated to protecting an institution internally? That's an interesting point, Anthony. Is that, depending on what you mean there, is that not the internal compliance function within organisations? Yeah. And finally, Tricia said, go ahead, Eric.
I would say so. I think in my experience, the trouble is you can have your 3 lines of defense from compliance, but then the trouble is if that's siloed, and so you have risk over here, and then you have fraud. I don't even have enough hands to do the diagram, but you have fraud over here, right? And yeah, you have your leadership team who really is making all the decisions here. And none of these 4 departments, none of these 4 teams really communicate that much. You know, they have their own, you know, compliance has its 3 lines of defense. And in fraud, they're looking for completely different things. And indeed, I've consulted and advised financial institutions where if the fraud team sees something suspicious pertaining to money laundering, they throw it out the window. And if the AML team sees fraud, that's none of our business, right? So imagine both of those teams who don't communicate. When they do find something suspicious, it goes to a leadership team that says, we're just here to make money, guys, right? We're just in this for the good old fashioned shareholder value. You've got Jack Welch at the top in the 90s who said, you know what, good for you for finding that, but we're going to take the risk anyway. So, this is a very complex issue to say, can we tighten up the 3 lines of defense in our compliance team? I think that should always be tight. Will that solve all of these issues? Could that have prevented some of the recent banks from having trouble? I'm not so sure.
Okay, and Tricia says she previously antagonized me with the very high temperatures, but I'll still read out her question. Here we go, Tricia. When conducting an internal assessment, how much sampling from the customer's portfolio is recommended to be assessed by the compliance manager to better mitigate risks? And just before I ask Eric for his comment on that one, of course, that's one of the arguments for using AI, because you don't have to sample. In theory, AI can process all of your transactions. Correct. But then it depends on what comes next, which, as Eric says, is technology can alert and humans intervene. You could actually be turning away some bona fide business that just requires a little bit more time to look into it and check. But the simplest thing is knee-jerk, get rid of it. Just like the simplest thing perhaps in the leadership, the senior management who probably own the shares in it and will stand to make the most, say, well, I don't know, let's give them the benefit of the doubt. What about this idea of sampling in Tricia's question, Eric?
No, it's certainly a good point. But like you, I think we have technology. Certainly, I've seen technology that can handle that now, provided that we can get all of the data into the software. But if you can do that, get the transactions, get the client data into software, there's sophisticated enough AI now to give us risk scoring, right? So even at a very basic level, we could say, green is low risk, yellow is mid, red is high risk. So if you had 10% of your accounts being high risk, let's have somebody review those. Let's have the team, either compliance or a risk team, look at those ones marked red by the software. Now things will slip through the cracks, but it is a way to segment your risk portfolio, and regulators do really expect to see this and like seeing this, is a kind of segmentation by risk level in the technology. And again, we look at the ones marked in red, and in theory, investigate and elevate to senior leadership for additional review.
Yeah, an interesting point here. On my screen, it's the penultimate one. Unless you want to put any more in, there's one from Deborah and the one from Tricia. Deborah says, in the banks that are too big to fail, would you foresee a scenario where self-regulation, i.e. the company appoints their own chief risk officer, or doesn't in the case of SVB, that it becomes centrally controlled? The regulators appoint the chief risk officers. Any merit in that? Banks will go, I don't want it, but
it's an interesting idea. Do I see that happening anytime soon? Probably not. I think it's a very interesting idea, wonderful idea. It would have to be, though, if you did that, I think it would have to go beyond having, this chief risk officer. It would have to actually go to the board. And so everybody's been sort of ESG is that hot sort of topic hot catchphrase, I think, has been for a couple years. I was at a wonderful conference hosted by Transparency International. Says, guys, we cannot forget about the G being governance.
Governance, yeah.
So I think if there was, hypothetically say, okay, the regulators will pick the person, Stephen, you're going to be the chief risk officer at Big Bank because it's so important to our country. We need you there. That it would also have to be, it would have to say, if there's 10 seats on the board, that 2 of those are also going to be appointed by us. It's a very interesting concept. Again, I don't think this is necessarily coming, but a novel idea.
All good things start out somewhere, and then to finish things off, unless somebody wants to come up with another question, Tricia comes back for a second bite of the cherry and says, what are some of the things to look out for when deciding on financial crime risk management software? The board will say we want it cheap. The board will say we want it to be 100% effective. And the board will say we don't need a compliance function. But that's me being cynical. Eric.
No, but you are right.
You were talking about the software that has red, amber, and green. Yeah.
Yeah. So in my view, and again, my passion has been sort of in building technology and leveraging AI wherever possible in this field. Certainly, okay, putting cost aside for a second here. Yes, risk scoring, very important. Right? The ability to bring in data, multiple data sources. I think this one is sometimes taken for granted. Oh, yes, we've got the data. We'll pull it in. We can bring in the sanctions lists and the PAP lists, and we can get some negative news in there and build this amazing tool with all that has, this Ferrari, and we can fuel it up with all of the best data. Very challenging. So I would press to whoever's building the software for you, or if you're going to a third party, really press hard. How do I bring in external data? How do we integrate our own customer data and make these things work within the tool? It's very, very important. And then another consideration is, how well can we screen against some of the very highest risk data points, those being international sanctions lists. And we could probably do another webinar here purely on sanctions, Stephen. I would say, how do we screen against recent Russian sanctions and the existing, the OFAC list, the OSPI list? But that's going to be absolutely crucial to using any kind of software at a financial institution to look at risk and AML.
You can tell from the trouble I had resizing the screen and the font, technology is not my strong point. However, I am aware that much of the data we draw in, some of it will be from legacy systems. Is it compatible? There are ways to solve all of this, I'm pretty sure. So there we go, everybody. I think I can't see any more questions and answers. Thanks for those. Thanks for your responses, Eric. This is the marketing plug. If you want to know more about these kind of topics and look at them in a structured way, well, Bangor Business School Executive Education is here to work with you. Cutting edge, innovative learning. We have 2 products, the Chartered Banker MBA and the Financial Crime and Compliance. They both cover different things. The name is in the focus is in the name, Financial Crime and Compliance. Doesn't mean that we teach you to be a financial criminal. It's how to be compliant and avoid that. So you can take the whole programs. There are different routes into them. There's the full program, depending if you have qualifications and experience. You may get some exemptions. You may prefer to start out by taking a single module from either of these programs as a taster to see, well, perhaps it's some time since I've been in education. What would it be like? Because I'm a busy person, and we know that. So we've been running these programs for over 10 years using platforms of distance learning. And there the brochures are showing. And you could begin your studies this April, okay? Yeah, later in the month of April. And there's a brochure coming up there. You see some links to them. Get in touch with us, and we'll be happy to talk you through your options. It remains only for me to thank Eric. It's always great fun working with Eric in these sessions. A little bit of banter, a little bit about the what's the weather doing, but more importantly, great insight there, Eric, from somebody at the cutting edge with lots of insight. Thank you so much, Eric. As we say in Wales, diolch yn fawr iawn, and as we say to everybody else, thanks for coming, everybody. If you want more information, get in touch as on the screen and with the brochures there that Jan has just put in. For now, bye-bye, everyone. Bye, Eric. Cheers. Thanks a lot.
Thank you, Stephen. Thanks, everyone.
Bye-bye.